Here, let's send it over to Josh Brown right now for an update to his best stocks in the market. Hey, Josh.
Hey, what's up, Mike? We're going to do 3 very quickly, and one of them is a throwback that I know you'll appreciate. But let's talk Morgan Stanley. On November 20th, we brought this idea to the show. It had been in a 9-point drawdown from a recent record high. And we basically looked at this thing, tangling with its rising 50-day, and said, everybody wants to talk about buying on dips. Well, here it is. One of the best stocks in the market, sitting in a dip. You can have it. Obviously, that has worked out well. I wanted to bring it back because if you think this rally runs into year end, all of the drivers are things that Morgan Stanley benefit from. Wealth management, asset management, trading, the investment banking renaissance, IPOs, M&A. They're a player in all of these things, and I think the stock price reflects that. This stock's going higher. I wanted to bring back Ciena as well, C-I-E-N. As Michael and Joe and Jimmy and Shannon probably remember, this was one of the darlings of the Internet 1.0 build-out. Well, they've just become an AI darling this year as well. This is a stock that is already in a breakout, and it's got a really well-defined downside here. So if you look at that recent sell-off when the AI trade got shaky, that's about 172, 173. That's where you set your stop, so long as she remains above. I think you want to be long this name. You could buy as many GPUs as you want for your data center. If the infrastructure is not talking to each other, it's worthless. Ciena is that telecom infrastructure. Last name is Baker Hughes. This is oil. Oil is only 3% of the stock market at this point. Nobody cares until they care. Gold shocked the market this year. People did not expect gold to have the year that it had. Don't be surprised if we're not talking about oil the same way at some point next year. Nobody is long. Baker Hughes reports week after week a declining rig count. At a certain point, that will bottom. If and when it does, this thing's going to go. And it's already at record highs without any improvement in the price of crude, any improvement in rig count. Those are the big drivers here for this name. If and when that starts to happen, again, these stocks are all under-owned, especially Baker Hughes. This is one of the best stocks in the market technically, and I think the fundamental picture improves going into Q1. So these are all 3 names on my list, all doing well, and I wanted people to hear that.
All right, Josh, and I appreciate you. I can always count on you to just point out that I'm older than you, talking about the throwback names. Although you say Baker Hughes, nobody owns it, I think maybe Joe owns it.
Can I correct my 516 little brother for a second? So we've owned Baker Hughes for quite some time now. It is up 19% as I see it year to date. It's up 12% on a 1-year basis. It's been a remarkably strong stock. I think Josh is right. Energy ownership is at a very low level. I would call it underweight. Baker Hughes is working. Also, refiners working, Mike. Valero, Phillips 66, Marathon.
Shannon, energy as a general matter, any reason besides it being under-owned, perhaps?
It's under-owned, but I also think that it's tied to the fact that there is this concern about oversupply, particularly in nat gas. But if you think about the necessary spending and the power issue that's associated with AI, natural gas is going to fuel a lot of that. And so there's an opportunity for investors who are probably under-owned if they're in the index to be able to add to their positioning going into 26.
And nat gas actually has had a pretty good move itself, and obviously exports and all the rest of it, part of that story. Do you want to get Jim on Ciena relative to maybe something else in the group?
Well, I love where Josh is with this, a similar vintage stock Cisco. Frankly, Josh, I think we have to think about these in the same breath. But they both have the same fundamental drivers. Okay, but here's the thing. This appeals to whatever type of investor you are. If you're a large cap, more value-oriented investor, which, yes, I still am, then Cisco appeals to you. On the other hand, if you're a more growthy investor, in particular mid-cap, yes, Ciena at about a $28 billion market cap. I do consider that mid-cap. Hey, that's your baby. I mean, the same drivers are in place here. Data centers, all the AI infrastructure build-out is going to benefit both stocks. So just, pick your horse according to what type of rider you are.
Jim is right. So Ciena's like the high beta little brother of Cisco. This company put up 29.4% revenue growth last quarter. Cisco couldn't do that if you put a gun to its head. It's 2 totally different ways of capitalizing on the same theme, and there's no reason why either one of them couldn't work. So I think it's really more a question of, like, how much momentum are you looking for? What kind of margin of safety do you need from an earnings multiple? But I agree with him.
And how much risk is there in this part of the food chain if all of a sudden people start talking about rethinking of overall budgets, or maybe it can't be all companies at all times?
A lot. So, and that's where the different investing styles come into play. So if for whatever reason there was another moment where the AI CapEx story were in doubt, or God forbid somebody canceled plans for a data center, like Cisco's going down, Jim probably goes in and lowers his average cost and buys some. When I talk about the best stocks in the market, I'm not interested in them once they become not the best stocks in the market. So everything we write at CNBC Pro comes with stop losses for both traders and investors. Nobody's looking to get married to Ciena. By the way, I owned this as a retail stockbroker. I built a position in this in the late 90s. It didn't end well, although the stock went up thousands of percentage points. Like, the ending is never pretty. So, Mike, that's a really great point, and that's why we talk about risk management in the same breath as we talk about opportunity.
It's an excellent point, and I think you have the ability to risk manage much different than you did in the 90s. And one of the ways you could do it is continue to look at where SoftBank is trading. You're looking at the CDS for Oracle. You're looking at the CDS for SoftBank. It's very clear that there's hedging activity going on against the $18 billion corporate debt offering in September by those who took the other side of that trade. But SoftBank has been on the decline now probably about 40% since October 29th. And I think that's reflective of what Josh is talking about, the concerns that maybe there is a stumble or a bump somewhere here with this AI narrative as you move towards 26.